What are some of the most underused, underutilized tax deductions and tax credits out there that you need to see if you should capture? I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so there is a space. Every time you get your taxes done, there's this space between your return being prepared and you actually filing it. Between your return being prepared and you actually filing it. Now, you might be saying, no, there's not. I get my return done and I click the button, I sign it, and I'm done. Most people actually don't exercise, don't capture this space. But you need to, okay? So whether you're working with a CPA or whether you're doing it online, your return online, when your return is done, before you file, work and manage this space. Why? That's where the magic happens. That's where the planning happens. In this gap, in that space, and we do this for the clients that we serve and have been doing it for decades. In that gap, that's where you do your proactive tax planning. You answer 3 different questions in this gap, okay? The first one is, do I understand why the return turned out the way that it did? Okay, and this is a review of the numbers before you actually file it. Review your work. No, it's not that geeky, but it is just double checking, make sure that you've got all of the tax documents entered in correctly, that the return makes sense, you're not missing anything. I think a lot of people this year will realize, oh, I forgot that bank statement. It's actually paying interest this year or something like that. Also, where you make sure that deductions and credits that you're eligible for, that you're capturing those. We're going to get into that in just a second. That's the first question. Second question is there anything that you should do right now before you file the return to improve last year's return? Yes, there are some things that you can do all the way up until April 15 for last year's tax return to improve last year's return before you file it. I'm going to share some here in just a second. So that's the second one, okay? And then the third question, actually, you could do it in this gap or right after you file the return, that's okay. But that is, are there any changes to your tax planning for this upcoming year, for this current year that you're in? Changes you should be making right now to your tax planning so that a year from now, your tax picture looks even better. Should you change your 401k contributions, maybe switch from traditional to Roth? Should you change your tax withholding? Something like that. Is there an adjustment to your tax planning that you should do right now in the spring to improve your tax picture a year from now? If you don't create that gap between filing your return, between preparing your return and filing it, then you're going to miss those potentially tax savings, tax planning opportunities. And guys, we do probably 3,000 tax returns over that each year, and it's this gap. It's this gap where we help people minimize their tax bills and pay the least amount of tax over their lifetime. In that gap, we are pointing through, or we are working through several different tax strategies for each individual situation. In that gap, what are some of the tax strategies that we bring up? What are some of the most underused tax strategies that we bring up? Well, I've got a 2-part series. We're going to hit the first 3 right now. The first underutilized or underused tax benefit is a tax credit. Okay, deductions are good, credits are great. Credits are a dollar for dollar reduction in your tax bill. It's my favorite tax credit out there. It's the retirement savers credit. Why is it my favorite? Because it gives you a tax credit for doing what you should be doing anyway for your financial life, and that's saving up for retirement. And I'm not talking about the normal tax benefit that you already get for saving up in retirement. If you're saving pre-tax in your 401k, your contributions are a deduction, so they lower your taxable income that year and save you tax. I'm not talking about that. I'm talking about a tax credit above and beyond that, a tax credit that you don't pay back, a tax credit that goes on your federal tax return. Now, not everyone gets it. You got to be eligible. Your income needs to be below a certain threshold, and for 2023, married filing jointly, your income needs to be below about $70,000. Now, why would this be an underutilized or underused tax credit? Because for most people, it happens sporadically. It's not something that consistently you're working and you're getting. For some people, yes, but for most people, your income, something happened, something unique happened in your financial life where all of a sudden for this unique year, your income dipped below that threshold, and all of a sudden you didn't have this on your radar, but all of a sudden you're eligible for the retirement savers credit. So things like, well, I graduated college and I'm just starting to work, so I have a part year worth of income. I just retired, and therefore I have a part a year of income. We had a child, and therefore we went from 2 incomes to 1, or spouse went part-time or something like that, and incomes below that. I lost my job. And I had some months where I was unemployed and looking for that new job. I started a business, that sort of thing. And where all of a sudden it wasn't on your radar that your income was going to be below these thresholds, but now it is. And you have to do something, you have to act, you have to make a change in order to capture the maximum amount of this tax credit. And then the second reason that it's underutilized or underused is not only is it not on your radar, but the maximum tax credit for the retirement savers credit is on the first $2,000 of retirement contributions per spouse, per person. So married filing jointly, this is a very, very common scenario. Okay, we went from 2 incomes to 1 because one of the spouses retired or went on maternity, something or got sick or something like that. And because we went from 2 income to 1, all of a sudden our income's below this threshold, and now you're eligible for the retirement savers credit. You weren't aware. Well, the individual that worked the entire year, say they were contributing 10% to retirement, and so that maybe they contributed $8,000 to their 401k. But the individual that stopped working or went part-time, was still contributing a little bit, but it was only a couple $100. Well, again, that tax credit is on the first $2,000 per person. Well, one spouse contributed $8,000, so they're going to max it out on the first $2,000, but the other person contributed just a couple $100. They're not going to max out because they didn't contribute a full $2,000, right? So it's in those scenarios, in this gap between preparing your return and filing it, that you would look and say, you know what, you're actually eligible for the retirement savers credit this year. We need an extra $1,750 contributed to Susie's Roth IRA, and that will allow you to max it out. Better yet, in some instances, we should contribute that to the deductible IRA, her pre-tax IRA. That will get your adjusted gross income down even further and make you eligible for even more, an even bigger amount of the retirement savers credit. Better still is being aware of this strategy in advance. And where I said you've got to capture this window, this gap between preparing your return and filing it. Guys, tax planning is something you do all year round. And if you're working with your CFP and you know that it's going to be a unique year in income, there's going to be a dip, then, because for a lot of people, they might look and say, well, because it was a partial year of income, we don't have the extra cash to contribute to the Roth IRA or maximize this retirement savers credit. If you would have known it in advance, you could have reduced one spouse's 401k contribution. Instead of them putting $8,000 in, you could have capped theirs at $4,000 or whatever, and then you would have enough cash flow to have the other spouse contribute extra as well. The same amount's going into retirement in that scenario, but you've strategized so that you're maximizing this retirement savers credit. All right, second underused tax benefit is a tax deduction. And part of the reason why it's underused is people aren't aware of it, but the other reason is it's part of your itemized deductions. More and more people, that the standard deduction has doubled with the Tax Cut and Jobs Act. More and more people are taking the standard deduction and not itemizing. But everyone can add up their out-of-pocket medical expenses above 7.5% of their adjusted gross income. Most people, that doesn't help them as much. But then your state and local and property taxes, so you're capped at $10,000 there, your mortgage interest, and then charitable contributions. If you are itemizing, likely it's because you either have a lot, because of the state and local income, that $10,000 cap, it's because you have a lot of mortgage interest or a lot of charitable donations. If you've got a lot of charitable donations and that's causing you to itemize, odds are you might have a lot of charitable miles or volunteer miles, and that's the underutilized tax benefit that many people are missing out on. If you're just donating cash or you're just donating gently used clothing or whatever, that's fine. But if you're also donating your time, then you want to be tracking any out-of-pocket expenses related to travel for that charity, for that volunteer time, and you can add that as part of your itemized deduction. 14 cents on the mile, and then any of the receipts for tolls or parking, that sort of thing. One of the organizations that I volunteer with, I had shared in a recent video that we just did a weekend camp, and it was a 5-hour bus trip with middle schoolers up to this camp. 5 hours there, 5 hours back. And I was blessed enough to be sitting on one of the buses with 56 other middle schoolers. Well, a few of the other adults, there weren't enough seats on the bus. We sold it out, enough kids were coming, and so they had to drive themselves. Well, that's a lot of miles to put on their vehicle, right? And you're driving 5 hours up, you're driving 5 hours back. It's a lot of miles. Hopefully, those individuals captured that, and they can add this deduction on their standard deduction. So volunteer miles driven for charities. Final underused tax benefit that we're going to talk about today in part 1. Make sure you checked in tomorrow for part 2 of this, but is your property taxes, getting a deduction for your property taxes. You might say, well, I don't itemize. And that's why I'm bringing this up as an underutilized and underused tax benefit. If you itemize your taxes, then your property taxes and your state and local taxes all get combined into a category called state and local taxes, SALT, okay? But there's a cap that even if you itemize, only up to 10 grand of your state and local and property taxes can count towards that. But most people don't itemize. So you might be thinking as you're preparing your return, whether you provided stuff to your CPA or whether you're doing it yourself, when they ask for your property taxes, you might already be thinking one step ahead and be like, I'm not gonna itemize. I'm not putting this stuff in. But you could be missing out because depending on the state that you live in, many states offer a state tax deduction on the property taxes that you pay. And to me, they should. I mean, good riddance. Why, property taxes and state taxes, you're having to pay property taxes on land you already own. It's the mortgage that's never paid, but I'm not gonna get on that soapbox. But so many states offer a state tax deduction for the property taxes that you pay. Well, if you ignore your property taxes when you're doing your taxes because you say, I'm not itemizing on the federal side, then you're missing out on this state tax benefit for your state. So make sure that as you're going through and preparing your return, this is something that you double check in that first question. All right, let me see, make sure I've got everything entered in here. This is one that hopefully your CPA would catch, or you should catch as you're looking at your state return and saying, oh, I missed this deduction here. Property taxes. Okay, let me make sure I grab my property taxes and input that here so I get that deduction on the state. All right, so those are 3 of the most underused, underutilized tax deductions. Hopefully that helps you. This is just part 1. Make sure you tune in tomorrow. I've got 3 more for you. Work with your certified financial planner on that because this is not an exhaustive list, and you need tax planning to make sure you're aware of all of the tax benefits that you need to be considering as part of your financial plan and tax plan. So work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.